Okay, good afternoon. The topic today in our series Exit with Impact is De-risk your project. This is a special deep dive which was requested from the participants in the last webinar. And so here's what we're going to cover today. This is all mainly about de-risking the projects. So first we will do a short overview and a recap of what we have covered in the previous call, in the previous webinar, and then talk a little bit about the key challenges and risks. So what are the areas of risk in innovation projects? And then I will walk you in a bit more detail through the case study. This was actually the key point that was requested in the last webinar, where people found this really interesting and they wanted me to walk them through this in a little bit more detail, how to do it and what it would include. And then, of course, again, I will be available for a short Q&A here live at the webinar, and also for a short period of time in our Facebook group, which I will tell you in a minute. This talk is designed for investors in the corporate area also. So for people who want to safeguard investments, who have made investments or about to make investments and want to make sure that there is a return and that the risk is under control, of course. Then in the middle, the entrepreneurs, startup, scale-up leaders, teams, managers, founders who have a project going on and who want to go more on the safe side, not only pushing it very hard, but making sure that the risk is under control and that there is a high confidence of a very good outcome. And of course, ecosystem partners, accelerators, investment managers, family offices. We had recently a talk to a group of investors, and they found this particularly interesting and asked us to look at some of their projects with the methodology. The replay, as always, will be made available. So for those of you who signed up into the webinar, you will automatically receive an email in your inbox with a link to the replay after the event. If you open the email up a little bit later and it's not there anymore, then just check in on YouTube /WITTIGONIA. So go into YouTube, find us there in our channel. The detailed version of this briefing series will be made available in several areas in the online academy. So the link is given here. It's academy.wittigonia.com. And probably as a starting point, we put it here in the briefing center Shape Growth, which is a free of charge briefing center. So you can just sign up and listen there also to some other webinars that we did in the area of innovation and growth, of course. After the webinar, I mentioned it before, there will be live Q&A. The Facebook page is called Shape Growth. So facebook.com/Shape Growth, just one word. And there I'll be available to answer some questions that turned out to be quite useful. My name is Thomas Wittig. I am the CEO and founder of WITTIGONIA, based in Zurich. That's where the company is mainly located, and working with clients pretty much around the globe, from Australia, New Zealand, all the way to the Americas. The focus area, of course, for us is in Europe and in the heart of Europe. And there we work with corporate clients, public sector, but also innovators, specifically people who want to grow their business. So we have a number of sessions, webcasts, seminars articulated, and you can just check on our homepage, wittigonia.com, or wittigonia.net actually is the address, and then you will find it there. In support of the growing innovation ecosystem in Europe and in other areas, we engage with a lot of players in the ecosystem. Here's just a small selection of what I have personally supported, or I'm about to support during the course of this year. And we did some interesting sessions in many different countries, all the way from South Africa to also European countries, where we had a great tour throughout the Impact Hubs last year. My experience and expertise in working with companies really extends everywhere from my early days in a startup named Microsoft, which then became a really interesting story over the years. Worked a number of years at another giant, SAP, where I led some work in the SME area and the partner business. And then, of course, worked with a number of high growth companies with a focus in the ICT sector, or also the e-health sector when it comes to the connection to IT. Now, this is the roadmap for the full talk. As I mentioned before, we will focus on this particular session today on these 2-3 topics here. I'll walk you through a little bit through the timing and exit planning process and talk about some of the success and failure factors. And then I'll focus more on the case study today. So that was the main interest point. And as always, you can send us questions during the webinar or at the end. You can even do this at the replay. There's a message button there where you can reach out to us, and we will fold it into future sessions. So let's just jump right ahead to point number 2, which was the exit planning and timing. I always get the question, okay, when is it a good timing to start thinking about the exit? Are we too early, too late? Where should we be starting? And obviously, when you come very close to a potential exit discussion, then thinking about how to get the company in shape and how to manage the risk is almost too late. So then you have to deal with the situation as it is, and that might actually impact in an unfavorable way the exit process and predominantly the exit price, of course, that you may want to ask for your company, your property. But more importantly, on the management side, the last minute scramble is not something that anybody would like to see, neither the investors or the M&A partners, and also not the teams. It can create conflict and surprises and discontinuity. On the other hand, if you start too early in the process, you may set the wrong tone for the company altogether. I have seen 2 extremes in this regard, and it's not so much fun to work on the extreme. I think it's a good way to start somewhere here in the middle, doing before or during the due diligence process, before a deal is signed, so that people have a good set of shared beliefs of what exit criteria, timing, and the conduct might look like. For investors, I would say also start early with the discussion about the exit strategy, so that it doesn't come as a surprise. Finally, if I'm an investor, then I want to have a return on investment, however that looks like, in terms of return on investment or social return, financial return, etc. And along the way, inspect the expectation, but don't pull out the flowers to see how the roots are growing. That's an important thing to keep in mind. Just checking every 5 minutes how the team is doing is not helping anybody. Now, really, what we are suggesting to do is to start early and articulate the vision and the goals, and also make that part of the project selection criteria on both sides, actually on the entrepreneur side as well as on the startup side and the investor side. So you want to make sure that there's a good fit, and then follow through with these planned milestones. I think this is also in mutual interest to do milestone reviews and checkpoints, so that everybody knows if you're moving along the project as it was supposed to be. And then along the way, we would start preparing clients, stakeholders, people, etc., about potential exit activities, right? So this chart is only speaking about this part of the process, of course. And then eventually there will be an exit where the company is being sold, merged, is going public, or whatever the exit scenario might look like. Now, going to the next step, what makes it difficult for the innovators to run such innovative projects and really to build something out? So first of all, I think the biggest, one of the biggest area that we usually see, it's about adoption in the marketplace or in the customer base. That means people finding people to buy the solution, but also to make sure that they are staying customers. So ideally, what we want to see is something like this famous S-shaped growth curve that we see here, where you have what typically not much is happening for some period of time, but then when the market is kicking in, you have an accelerating growth. So the rate of growth is accelerating until you have some kind of an inflection point, and then you have captured a large degree of the addressable market, and it's staying like that. Now, in reality, it looks really often more something like this, unfortunately. So it takes much longer. The aspiration in terms of market share is not so great, and then there's even a decline. Could be even a sharper decline. So we call this an overshoot and collapse scenario. And it's important to understand why that is the case. So we are walking people through these dynamics of the adoption, and I actually wrote an article about this blog post. You can check on the website. It's called Hockey Stick Confessions. I did a field study in workshops and also some formal surveys where I found out that people really have a hard time to understand how the accelerating growth or the viral adoption is really happening. So that's something that is almost the basic that we need to understand as entrepreneurs and also investors. Now, looking at across all the projects, what we often find is a large share of the projects are struggling because of product adoption. So that is really the lion's share of all the difficulties. And then it comes down to team dynamics. And funding and technology are usually not so much the problem right now, and not anymore. But you can also make the case and say that there is it's a correlation between the team and all the other areas, and that is of course true, and that's why we suggest for customers and investors to invest not only in the product, but really invest heavily time, money, resources, coaching, mentoring in the team in order to make them really work together very well and have the capability to run the business. Now, going more on the operational level now, what is happening on the operational level is also important. Ideally, you would enter in this kind of virtuous cycle where you drive performance, which creates credibility. You get the support from the organization or the investor, who are then allocating resources and gives you more ability to execute. So that drives success to the successful, so to speak. Now, what is really happening, there are a lot of, let's say, forces which we have to cope with in terms of the project dynamics, adoption dynamics, organizational dynamics, especially in large organizations who are driving projects. And this is a big topic that I am talking about and working with teams right now in the series of it's called transformation dynamics, where we look at these areas one by one and then really unpeel the onion and understand what is driving these difficulties and why is it so important to make the market adopt our products. Yeah. Now, again, drilling down on really the dynamics on the project level. This is a very rich topic, of course, but just want to highlight here. It's one of the major areas of risk, of course. And what typically happens is we have a starting point where we have a plan, a certain budget and a schedule that we are shooting for. And then over time, we find out that it, of course, takes much longer than we have planned, and it consumes more budget. So it depends really on where these projects are. There could be a significant budget and schedule overrun. And drilling into the details of such projects, we often find that there is an inherent project dynamic which makes it difficult. So it could be a fairly rocky movement, something like this, where you have these step functions. And in the Transformation Dynamics series, I'm explaining why that is the case and why even great project managers are struggling with this almost compounding effect of errors and problems that lead the projects to actually run fairly late. And this is not an extreme case. I mean, we have seen other extreme cases where you say, okay, we're going to be live in a year, and then it takes 2 or 3 years. And I'm not talking about the Berlin airport here, of course, but let's say some software development projects, software as a service projects, even campaign development, etc. And so what we see at the end is that is more a movement like this, where we have also slow starts where people ramp up, and finally the work is catching up with them, or they're catching up with the work, I should say. And then at some point in time, we have somewhat of a budget overrun. And here's an output from a simulation that we did for different settings. So, for example, when you have a company which has a service business and they want to drive a product. That's why you see the different lines here, the different simulation runs. This was actually taken from another briefing that I did. It's called productizing. Productizing means you, as I said before, you have a service business and you want to drive a product development. And many, let's say, agencies, service organizations, software development organizations have that problem because they are, they tell me in private meetings they are sick and tired of driving the pipeline, and they ask, okay, how can we actually use our skills to develop products which are then more scalable? But easier said than done, especially if you have to do it on a running operations. Now, budget and schedule overruns are a sign, and I should add here, they're not a favorable sign. So I would pay closest attention to what's happening on the project and operational level, because that's where the risk is unfolding, and we have to be very very clear and very specific in reviewing these kind of projects. Now, I'm skipping a couple of slides here, just to let you know, as I mentioned before, people have a difficulty in estimating the impact of word of mouth in both ways. Keep in mind, word of mouth can have a positive viral effect. So the more people you have in your customer base, the more will come. But if you have a quality issue, the word of mouth can actually backfire. And if somebody says, okay, I bought this phone, now I switched the vendors, I switched the hardware, you should do the same. And then your influencers could create a drain in your customer base. But what we did here was actually we asked people to estimate how such a scenario would look like with these parameters. So 25 million customers, you have a certain customer base, and they have contacts with the potential customers. How would this unfold? And then what we found out, to cut it short here, actually the detailed description is in the research report that you find on our website. If you go there and search for Got Viral, or the blog articles called Hockey Stick Confessions, then you will see more about the explanations here. But the key finding was most people estimate that their traction would be very, very good. Actually, they overestimated too good, and they don't know that it's taking much longer in this kind of setting. Now, on the sales volume side, and this was an interesting surprise, most people thought that, well, we have so much time until we hit the peak in terms of the sales volume, but then it turns out that it comes much faster, and then the sales is declining, and that has a very dramatic effect on any organization, because if sales is coming back and they say, okay, we have hard time selling the products, there are no more customers, then all hell breaks loose, and because you have to figure out how to come forward with the next generation product that you can work with. Now, you can learn more about this in the Shape Growth series. Here are the links in the online academy. I want to move forward to the next chapter, but just keep in mind this inability to estimate the viral adoption is not, of course, an intentional thing. It is an evolutionary thing. Our human brain does not cope well with complex nonlinear systems. So that's something to keep in mind. And we have to work with that and train our teams to do better, of course. But the key focus topic for today, which I want to cover now in the next minutes here, is about how would you go about de-risking projects or impact projects. This was actually taken from a call that I did to a group of impact investors, because they were asking about how can we make sure that the project is not only delivering a financial return, but also a social return. How can we take the risk out of the equation? Now, of course, the magic formula is not so difficult. De-risking means that you decrease the downside risk. So you basically eliminate all those factors that lead to, let's say, a loss or of capital or reputation or whatever. And you do as much as you can to increase the upside opportunity. So to say that, you have secured the basic performance, and there's a lot of potential for other opportunities. Now, there's a certain way to do this. And first of all, you would need to understand the opportunity and the risk factors, and systematically assess those risk factors and make the, let's say, the assumptions also transparent. That's the key point. And then along the process, you're surfacing the evidence for social and economic return, which means that you're walking with the assumptions step by step and see if they hold true. And then if you find that they hold true, you allocate the resources. Now, of course, this is part of a bigger picture here, and the key, what I would recommend, is to create, first of all, to set the tone and create a learning culture, so that people are not worried about risk all the time, but they do make informed decisions step by step. Now, the basic starting point for everybody would be to have something like this, which is a risk matrix. It's very common. So it has basically all the risk mapped out in a quadrant, which says, okay, you have an impact from insignificant to critical or high, or likelihood from not so likely to very certain. Now, this is a standard way of formulating this. It's not so difficult. Everybody should have this, and that should be the starting point. Now, the real question is where to start, and what would you do with this in our investment process? So ideally, you do this exercise early on. I would say actually in the due diligence process or earlier. You should demand that there is such a risk matrix. But then the interesting part starts, because we want to take this into this step-by-step milestone process here that we have laid out. Yeah, we want to understand how do we mitigate the risk, how to take the risk out of the equations. So let's take an example. Let's say we're starting with the picture that is presented here. So we have a certain, let's say, high-level profit and loss statement, a certain number of unit sales, deal size, etc. It doesn't matter what the product is. Could be a software solution or a community service or an agency service, whatever it is. And the picture shows that we have a certain EBIT contribution and the margin of 22%. Now, of course, we want to know, can this be, right? So what would be the range of possible outcomes? If this is the plan, how sensitive is it? And then what we do is we run a simulation with these numbers based on the assumptions that we have. And the picture might look something like this. So let's say we have here the zero line, which means that below the zero, the project or the company would incur a loss. That's, of course, something that we want to avoid. And then our, let's say, target performance of 22% would be somewhere here. And there's a lot of room and a lot of probability that this would be the case. But we still have to worry about this downside risk, right? So that's what we call here the downside risk. Now, as a next step, what I would then do is I go in there and say, okay, which one of the factors that we have in the business plan, this is only shown here on a high level. We can do this much more detailed, of course. And we put them in this, what we call the tornado chart. Looks a little bit like a colorful tornado here, the friendly tornado. And we found out that, okay, deal size has the biggest impact on our average performance. Yeah. So it has a lot of downside risk, but also a lot of upside potential. So we would go with this one first, and then drill into detail. And we need to, of course, understand here that in a good scenario, it could increase the EBIT very much, but in a very bad scenario, it could bring it down to quite a significant loss. So we want to avoid that, of course. Now, we take this and then we drill into the details, because we want to understand how is deal size distributed over the range of, let's say, the deals that we have made, the projects, proposals, whatever, the sales projects. And then we also do a simulation with that, and we want to understand what is the probability, the likelihood that it would be either to the one or the other extreme. And you see that here we have a fairly broad distribution. So it could be as low as 2K per deal up to 10, 15K per deal. That's quite a significant difference. And that's why it's important not only to talk averages. Averages are really meaningless. We need to understand the variation and the distribution over these parameters. Yeah, so that gives us a good handle. And now we can take this, of course, into our milestone review. And then if I have a good discussion with a milestone review, then of course I would think about my questions, right? If I'm a reviewer, I have, of course, my questions that I would drill down into. But if I am the person who is directing the project, then I should be prepared for these questions equally. So I would here, for example, ask the following questions. What is the distribution of the deal sizes? Well, if we don't have it, then when can we produce it? When can we have it? And then I would ask, what are the reasons for the deal sizes lower than the target of 7,500 euro, dollar, whatever it is in this case. And so we need to understand what is driving this downside risk here. Why are there some projects which have, let's say, very low deal sizes? And what is the pattern here? So what is the characteristic of projects where we can achieve higher deal sizes, of course? What's driving the wide variation? And how are you approaching this performance gap? So what improvement activities do you have in place? Now, there's a certain set of methodologies that you can use for that, right? So we're using a lot, let's say, the tool set from Total Quality or Six Sigma, of course, but there are other tool sets that you can use, of course. And then, of course, it's important to ask, okay, which are the improvement projects that are in place to improve these areas? It's not enough to say, okay, we are aware of the problem, we're working on it, right? That's nonsense. We really need to be very specific and drive a commitment here in this and in the accountability for these projects. And then, of course, to make it very specific, talking about SMART goals. So who is doing what by when? And then again, in order, or in the spirit of the learning culture, it's also always important to ask, do we have the right skills and the capabilities on the project? And if not, how are we building these? How are we contracting these from external, for example? If somebody says, okay, I don't know how to improve, let's say, deal size or attrition or churn rate or whatever the metric, the KPI might be, then just before losing too much time, go find an expert in the field and see how you can fix it. Now, in this scenario, our before and after picture would look something like this. So here we have the mean performance and the distribution before, and we have the distribution and mean performance afterward. And you see two things here, of course, which are important. So this is all about the reducing the variation, so to tightening up these curves and make sure that you have a more predictable performance. So the the closer the ends are together here, the more tightened up the distribution is, the more predictable the performance is. And that's what I want to have, because that's taking risk out of the equation, but only if I can also move the average performance. So moving the needle and tightening up the variation. That's what it is all about when we're running a de-risking the projects. Now, the impact on the profitability in this case would certainly look something like this. So we are also more on the safer side. There's a certain remaining risk that we incur a loss, but the majority of our potential outcomes, potential futures, I would say, the risk and return profile is really in a good shape here. So we can say with higher confidence that this project is going forward. And of course, that gives us more reason to allocate more resources to drive it even faster. Now, in this sample project, we would find that we have reduced the risk of probability of a loss from 32% down to 2.5%. So let's say this 32% refers to the area here under these curves, or all the bars make up 32% of all the possible outcomes. And here we have reduced that down to 2.5%. But also, it's more likely that we accomplish the higher performance, and our average performance was moving from 2%, so a 2% EBIT margin, to 28%. That's also quite a significant improvement. That's what we are looking for when we are talking about de-risking and systematic improvement, and when we say increasing the upside of an opportunity and decreasing the downside. Now, of course, what does it mean? Well, if I have this very wide variation, that means I have a significant risk, right? I cannot really decide if this project is going to be successful or not. So I'd rather not go forward with the funding. But if I have a fairly predictable performance where I can say, okay, I might take the risk, it's a fairly low chance that this project will fail, but most likely it will produce an outcome which is positive, then I go ahead and step by step, milestone by milestone, I am allocating the funding, of course. Now, there's some methodology behind it. We're going to make this short white paper available. It's a short presentation that talks about this in a little bit detail and how we work, but you can also contact us for things. Now, let me give you the checklist for de-risking projects. This is a bit different than what we talked about. It's more specific and down to the operational level here now. So first of all, ensure a learning culture of smart fails and informed decisions. That's really key. Nobody wants to work in an environment where you have, which is characterized by fear and control, but you want to make informed decisions in moving forward. Agree on a milestone review schedule and the reports that you want to have, and make sure that you have participation from everybody in the contract. It's also a tool for the entrepreneur by saying, okay, we have, let's say, a certain investment earmarked for this project, and we will show step by step that we have the performance, so we can unlock the funding, and then it would be allocated to the project. I mean, ideally, you have the entire funding at the beginning of the project, but that's not a reality in most projects, actually. The prudent investor would allocate the funding step by step, not in one chunk, but really step by step, and from milestone to milestone, given the performance on the key performance indicator, which have been agreed. And then, in order to de-risk the project, it would go something like this. So first of all, identify the risk and look into area what is endangering the budget, the schedule, and specifically also I call this internal and external adoption. For larger projects like in large organizations, it is really important also to think about how people internally will adopt the new solution or the new business model, and externally as well. Then identify the risk drivers, and then go step by step to confirm how the performance is actually working out, what the real assumptions are, and speak with facts. So it's a very straightforward process to do. Now, If you need help in this regard and you want to engage us or me as a review partner in your project or get a second opinion or training and coaching, we'd be happy to do so. So let's talk. We offer a wide variety of different things now, ranging from, let's say, advisory service to teaching, coaching, but also really business reviews. I think what is interesting to most companies when we take a look at the projects and provide guidance to the investment manager and the entrepreneur who is in charge on how to take the projects forward. Here's our contact information, which you can, of course, find on our website. The website address is wittigonia.com or wittigonia.net, the same. The replay of this session will be made available in the YouTube channel and in the briefing centers. As I mentioned before, you want to go to the online academy, academy.wittigonia.com, and look for the Shape Growth Briefing Center. And also, we will announce new webinars on the page, but also answer a couple of questions there as well. Okay, so I see that there were a few questions coming in while we were presenting here. So let me quickly check what these questions are. Some of the questions I actually have answered already in a previous webinar. So you may want to check for the basic called Exit with Impact. You can see that also on our YouTube channel. It has the green plants on the front cover. So question here comes about the starting point. When should you start the methodology? Well, my answer here is do it as early as you can. So not like in the last minute, but start thinking about this when you are actually, or before you are actually talking with each other. So before entrepreneur, investor, and the project leader are talking with each other. Make this part of the plan. If it comes too late, you can certainly do this, but nobody really wants to do the rescue and recovery mission or the last minute scramble there. Next question. Yeah, I get this a lot about cultural differences. So I mean, culture in two ways here. So the question is always, would this work in our organization? And there are two things to consider. Cultural differences might be a regional cultural differences. So people in Japan, for example, might work differently and have a different tool set than, for example, in South America or North America or Europe. And so what I have seen in my work within large organizations is that people really appreciate finding a tool set of working together, because it gives them, let's say, a certain lighthouse and a way of dealing with difficult challenges. Yeah, so this kind of projects usually is very welcome. Now, not everybody is prepared to do that, so there is, of course, material along the way to get people up to speed. What we love to do is to do a blended learning approach where we do a kickoff workshop, define the projects, and then over a certain period of time, provide some mentoring along the way on the job. We call this blended learning or experiential learning as well. The goal there is to empower the people. Now, the other side of the cultural question is, of course, in the different departments. Now, you may have a different culture in sales and marketing than in product development, IT, and operations. I fully recognize that. Now, what we have found is if you have to worry about the risk, it doesn't really matter if your project is in sales and marketing. So if I have a key risk on the, let's say, the sales funnel side or the marketing funnel side when it comes to conversion, I can use the same methodology. Now, it's always a matter of how quickly people are to adapt to this and how flexible it can be applied. And of course, in product development, where you have to think about quality, schedule, budget, this is also a great way to look at how you can de-risk the project. Because if you're running late with your project and you're consuming most of the budget, that's when a very unfortunate dynamic is kicking in. And usually it has it has a root not necessarily in development, but somewhere maybe upstream or downstream where you have started with the wrong assumptions. So again, that's why I cannot emphasize highly enough. It's very important to work systematically through firming up the assumptions. Yeah, then I have a question here, which is an interesting one. Somebody's asking, we have a project which is in danger. What would we do? So of course you can work with this approach already, which for projects which are in swing, which are even in danger. But there, of course, you have to take a little bit different tack, because sometimes they are so much into trouble that time is of the essence, and you have to approach it a little bit differently. So we then have to talk about a project turnaround situation, which works fairly in a similar manner, but I would approach it a little bit different. So now, if you need some help, feel free to contact me, and then I get you some ideas about this. Yes, yeah, a couple of questions. Some people came a little bit late to the seminar, to the webinar, and asking for the slides available. And we are bringing this out in the WITTIGONIA Online Academy and some other areas. So watch out for that. Take a look at your email or go to the YouTube channel, and there you will find it. What you want to do is look out for the cover slide, which I will show you in a minute. I think I covered many of the questions. There might be some more coming in. So if you interested in this, please join us in the Facebook community. And again, look for this kind of cover slide in the YouTube channel later on to identify the replay of this seminar. Having said that, I want to thank everybody. I went a little bit longer in this webinar than I wanted to, but it is good and great to have all these questions coming in. And please keep the questions flowing. Also share the insights, and rate and review the webinar on YouTube, please, so that we understand how to prepare the best content that helps you meet your objectives in your daily jobs. And feel free to get in touch with us on the social channels or directly if you feel that there's a piece of content that you would like to see, where we can make a drill down, and we'll be happy to do that. All right, so I would like to thank everybody and wish you a great project and hopefully a happy exit with impact for your projects and for your stakeholders. Good luck.